Okay, there was a little snafu on the exam date. Until this year, we did our uh, fall breaks on the presidential election years, on the week of the presidential election. Of course, I haven't looked at the calendar. Turns out this year we're having our fall break on the regular time, plus the Tuesday of the presidential election, which is November 5th. We don't have any class either. That's why our exam is going to be next Wednesday, 16th. Since I lost the class that I wasn't planning for, I'm not going to do Jeopardy on Chapter 6. I'm still going to give you the file so that you can use those as kind of your study guide. I don't believe in study guides. You're responsible for everything. That's your study guide. But if you want one, those Jeopardies are study guides. Questions are going to be similar. I'm almost done with porting my test banks into the new format. I mean, I spent almost all of yesterday doing all of that. I have to create separate test banks for required questions, replacement questions, easy, hard, but it's almost there. This week, we're going to cover Chapter 7, Valuation of Stocks. We'll talk a little bit about stock markets, the governance of corporations, especially how corporations elect their board of directors, and what does that mean. Today, I'll kind of develop what we call dividend growth model. It's basically a model that says value of a stock should be present value of all expected future dividends. Sounds nice. Theoretically, it's rather neat, but there are a lot of practical issues. In upper level finance classes, we use a little bit better models, but at the level of this class, we use the dividend growth model. Well, we're going to start with what are the cash flows from a stock. If you buy a stock and you intend to hold it until the infinity or the company ends its existence. Companies end their existence either by death, they go bankrupt, or they get taken over by somebody. Every once in a while, they go private, which means the majority shareholder buys out the minority shareholders. Dell, for example, have done that in the past. It is public again, but things could happen. The cash flows from a stock are simple. If you're going to hold them, they're the dividends. Now, let's think about bonds, especially the fixed type bonds. We model valuation of those as present value of the future cash flows from owning that bond. But we had an advantage. We knew exactly when or how much we were going to get. If I own a face value $1,000 bond, let's say annual coupons, with a coupon rate of 5%, I know every year I'm going to get $50 plus on the maturity date, I'm going to get $1,000. I know exactly when and I know exactly how much. If we have the proper discount rate, commensurate with the risk of the company, calculating the present value of those is not a problem. Whether you do that by a template or manually, also known as uncivilized way, you can calculate the value. With the dividends, dividends are paid by a decision of the board of directors. Next year, Coke, for example, is expected to pay a dividend of $1.94 in quarterly installments. Uh, but tomorrow, board of co can decide, okay, you guys are suckers. We're not going to pay any dividend next year. It is completely within their rights to say that, or they can say we're going to raise that to $4. So it is a discretionary number. Board is short for board of directors. But let's say we could all future dividends from now until the end of time. If company dies or ends its existence, obviously after that you get zero dividends. So you need to figure out a value for that. But let's kind of start things. I mean, eventually we're going to say value of a stock is equal to the present value of all future dividends. But let's see how we come to that. Suppose you have a 1 year investment horizon. You buy the stock now at P0, the current price. You will get, I put a dollar in front of it just to designate that it is dollar D1. This is your first year dividends. And sell the stock at P1. The trouble with that is I don't know what that P1 is going to be, but let's say I have means to forecast that. Well, if you're a good forecaster of future prices, you can make a lot of money in stock markets, but let's leave it at that for now. So value of company, which I'm going to say V0, I always make a distinction between value and price. Value is what you get when you buy something. Price is what you pay for it. They are not necessarily the same. But we're going to kind of wave our hands in markets that are informationally efficient. Value and price are the same, which means all relevant publicly available information is already included in the price. If you have private information which is not available to anybody else, the value for you is going to be different. I mean, somehow I have inside information, and I know, unlike the market, that we're going to grow twice at the rate the market expects. To me, the value is much higher, but the price of the stock is low. But as far as the public information is concerned, as long as there are issues with dissemination of information, in efficient markets, value and price should be the same. And at this level of sophistication, we're going to act as if that is the case. So we're going to view that as such. But if I know that, and suppose the proper risk adjusted rate of discount, or sometimes we call this required rate of return, is R. Just like bonds, depending upon the nature of the bonds, the proper discount rate is different. Bonds of Apple have a higher discount rate than bonds of Treasury. Why? However small, during the next 30 years, the chances that Apple is going to default is non-zero. It's small, but it's not zero, which means uh, if the cash flows are exactly the same, I would be willing to pay more for Treasury bonds compared to Apple bonds. Or I should be discounting Apple bonds at a higher rate compared to Treasury bonds. Just like that, stocks are similar. If I'm considering the cash flows, expected cash flows from owning Coke,